Silver runs out by March 2026. While banks load physical, right now in Dubai, physical silver is trading at $127 per ounce, while on paper, COMEX settles the same metal at 73. That's a 73% gap. In commodity markets, arbitrage eliminates these differences within hours, not months, but this gap isn't closing, it's widening. March 2026 represents a delivery deadline, and the registered inventory to meet those obligations doesn't exist. What happens when the paper promise meets physical reality? Welcome to Daily Silver Crisis. If this is your first time here, we focus on what institutional players are doing, not what they're saying. We'd appreciate it if you'd subscribe to this channel, the way you'd bookmark critical intelligence that affects your financial decisions. No hype, no predictions, just documented institutional behavior. And please, let us know in the comments where you're watching from today. Geography matters in commodity flows, and we're tracking a global story. Now, let's begin with part 1. In the last week of January 2026, a businessman walked into a precious metals dealer in Dubai with a simple request. He wanted to buy 100 ounces of physical silver bars. The quoted price was $127 per ounce. That same afternoon, traders on the COMEX exchange in New York were settling silver futures contracts at $73 per ounce. The same metal, two radically different prices. This is not supposed to happen. In functional commodity markets, price differences between physical metal and paper contracts create immediate arbitrage opportunities. Traders buy the cheaper version, sell the expensive version, and the gap closes within hours. But this gap has existed for weeks, and it is growing wider. Something fundamental has broken in the silver market. The traditional mechanism that keeps physical and paper prices aligned no longer functions. This is not a temporary disruption caused by shipping delays or regional premiums. This is a structural divergence that reveals a deeper crisis. To understand what is happening, one must first understand that there are effectively two silver markets operating simultaneously. The first market is the paper market, dominated by COMEX, futures contracts, ETFs, and unallocated accounts. This market handles billions of dollars in daily transactions. Prices move based on trader sentiment, technical patterns, and macroeconomic data. The second market is the physical market, where actual metal changes hands. Industrial buyers, sovereign entities, and strategic investors operate here. This market moves based on available supply, delivery timelines, and vault inventories. For decades, these two markets moved in lockstep. Not anymore. In December 2025, China implemented export restrictions on refined silver. These restrictions affect approximately 70% of global silver refining capacity. China did not ban exports entirely, but they introduced licensing requirements, quotas, and strategic allocation priorities. The message was clear. China intends to secure physical silver for its own industrial expansion, regardless of global market prices. This single policy shift removed the world's largest source of refined silver from free market circulation. Simultaneously, COMEX registered inventories have been declining steadily for 18 months. Registered inventory represents metal that is available for delivery against futures contracts. Eligible inventory is metal stored in COMEX warehouses but not available for immediate delivery. The distinction matters enormously. In January 2024, COMEX registered silver inventory stood at roughly 80 million ounces. By January 2026, that number had fallen below 30 million ounces. Meanwhile, open interest in silver futures contracts represents claims on over 600 million ounces. The mathematics are straightforward. If even a small percentage of paper contract holders demand physical delivery, the available registered inventory cannot satisfy those claims. This is not speculation, it is arithmetic. While registered inventories decline, industrial demand for silver continues accelerating. Solar panel manufacturing alone consumes approximately 35% of annual silver production. Electric vehicle components, electronics manufacturing, and medical applications account for another 45%. These industrial users cannot substitute alternative materials without redesigning entire production systems, a process that takes years and billions in capital investment. They need physical silver, and they need it continuously. Mine production is not increasing to meet this demand. Primary silver mines face declining ore grades, aging infrastructure, and permitting constraints that stretch across years. Approximately 70% of silver comes as a byproduct from copper, lead, and zinc mining. When base metal prices soften, silver production falls, regardless of silver's price. This creates supply inelasticity. Higher paper prices do not immediately generate more physical metal. The market is experiencing something historically rare, a growing gap between what industrial users need, what mines can produce, and what trading markets claim exists. In previous commodity cycles, rising prices would incentivize increased production. New mines would open. Recycling would accelerate, demand would moderate, but silver's industrial applications are largely non-discretionary. Solar manufacturers cannot reduce silver content without sacrificing panel efficiency. Electronics producers cannot eliminate silver from circuit boards without compromising conductivity. Medical device makers cannot substitute away from silver's antimicrobial properties. They must have the metal at any price. This is the context behind the 73% premium in Dubai. Physical holders understand something that paper traders have not yet priced in. The promise of future delivery is becoming increasingly disconnected from the ability to actually deliver. March 2026 represents a critical threshold in this divergence. Large delivery obligations come due that month. And the question facing the market is simple. What happens when institutional buyers stop accepting paper promises and demand physical metal instead? 7 Feb and October 2025, something unusual appeared in the COMEX delivery reports. A single authorized participant withdrew 4 million ounces of registered silver from the exchange vaults in 1 week. The withdrawal happened during a period when paper prices were falling. This behavior contradicts basic trading logic. When traders believe prices are falling, they sell positions and move to cash. They do not take physical delivery of a declining asset, unless they know something the broader market does not. This was not an isolated incident. Over the following 3 months, similar patterns emerged across multiple authorized participants. Large physical withdrawals occurred precisely when paper prices experienced coordinated selling pressure. The pattern revealed a sophisticated strategy. Suppress paper prices through futures selling, then quietly absorb physical metal at artificially low levels. This is institutional arbitrage at its most calculated. To understand how this mechanism functions, one must examine the structure of COMEX silver contracts. Each contract represents 5,000 ounces of silver. Most contracts are closed financially before delivery. Traders settle the price difference in cash rather than exchanging physical metal. Historically, less than 3% of contracts result in physical delivery, but that percentage has been rising. In January 2024, physical delivery requests represented 2.8% of open interest. By December 2025, that figure reached 6.4%. The shift appears modest in percentage terms, but in absolute volume, it represents millions of additional ounces demanded for delivery each month, and the registered inventory available to satisfy those demands continues shrinking. This creates a mathematical inevitability. At current trajectory, delivery demands will exceed available registered inventory sometime in the first quarter of 2026. March delivery obligations represent the critical threshold. Now examine what happened with margin requirements. In November 2025, CME Group increased initial margin requirements for silver futures contracts by 18%. The official explanation cited increased volatility and risk management protocols, but the timing reveals a different story. Margin increases make it more expensive to hold paper positions. This discourages speculative long positions and reduces open interest, fewer paper claims on physical metal. Yet during this same period, large institutional entities were increasing their physical allocations through over-the-counter transactions and direct vault withdrawals. The public message said, "Silver is risky, reduce exposure." The private action said, "Acquire physical metal while paper prices remain suppressed." This divergence between public messaging and institutional behavior is not coincidental. Follow the vault transfers. COMEX warehouses categorize silver inventory as either registered or eligible. Registered inventory is available for delivery against futures contracts. Eligible inventory is stored in COMEX facilities but not available for immediate contract settlement. Converting metal from registered to eligible status requires only paperwork. Throughout 2025, vault operators processed an unusual volume of these conversions. Metal that was previously available for delivery became unavailable, while remaining physically present in the same warehouse. The practical effect is significant. It reduces the pool of deliverable metal without actually removing silver from the exchange system. This allows vault operators to show total inventory numbers that appear stable, while deliverable inventory continues declining. The strategy becomes clear when examining lease rates. Silver lease rates represent the cost to borrow physical metal for a specified period. In abundant supply conditions, lease rates remain near zero. In late 2025, wholesale lease rates for physical silver began rising sharply. By January 2026, annualized lease rates for 1-year silver exceeded 4%. For a commodity, this is extraordinarily high. It signals physical scarcity in wholesale markets, regardless of what paper prices indicate. Sophisticated institutions understand this signal. They recognize that lease rate behavior reveals actual supply conditions better than futures prices. Now consider geographic flows. Silver moves through predictable channels. London serves as the traditional global hub for precious metals trading. Zurich handles significant refining and storage. Shanghai and Dubai represent major physical consumption centers. Tracking vault-to-vault transfers reveals institutional positioning. In mid-2025, unusual volumes of silver began moving from London vaults to Swiss refineries, then onward to Middle Eastern and Asian storage facilities. These transfers occurred during periods of paper price weakness. The pattern indicates strategic repositioning. Entities are moving physical metal from trading hubs to consumption centers, securing supply chains ahead of anticipated shortages. This is not speculation about future price movements. This is physical allocation to ensure access when markets tighten. Examine sovereign behavior. Central banks and sovereign wealth funds traditionally focus on gold rather than silver, but recent import data reveals changing patterns. Several Middle Eastern sovereign entities increased silver imports by over 200% in the second half of 2025. These purchases occurred through private transactions rather than public announcements. The metal entered sovereign storage facilities, not commercial circulation. This behavior indicates strategic stockpiling. Nations are securing industrial metals the same way they secure energy reserves and food supplies. They recognize that silver's role in energy transition technologies makes it strategically critical, and they are acting while paper markets still offer attractive entry points. The most revealing indicator appears in forward premiums. Forward contracts allow buyers to lock in future delivery at specified prices. In normal markets, forward premiums reflect storage costs and interest rates. In late 2025, forward premiums for physical silver began exceeding these baseline calculations by significant margins. 6-month forward contracts traded at premiums 8 to 12% above spot prices. This indicates market participants are willing to pay substantial premiums to guarantee future physical delivery. They do not trust that metal will be available at prevailing spot prices when they need it. All of these indicators point to the same conclusion. Institutional actors with access to delivery data, vault inventories, and wholesale markets are positioning for a supply crisis. They are accumulating physical metal while simultaneously managing paper positions to keep prices suppressed. The strategy is rational. Acquire maximum physical allocation before broader markets recognize the supply constraint. March 2026 represents the point where this strategy faces its critical test. When delivery obligations exceed available inventory, the market will be forced to reconcile paper promises with physical reality. 7. Febe solar panel manufacturing facility in Germany requires 18 grams of silver for every panel it produces. This is not a preference. This is an engineering requirement. Silver's unique combination of electrical conductivity, thermal stability, and resistance to oxidation makes it irreplaceable in photovoltaic cell construction. Engineers have spent decades attempting to reduce this silver content. They have succeeded in lowering it from 20 grams per panel in 2015 to 18 grams today. But they cannot eliminate it entirely without fundamentally compromising panel efficiency. And panel efficiency determines whether solar installations generate sufficient return on investment. This single manufacturing facility produces 12,000 panels daily. That requires 216 kilograms of silver every single day. Multiply this across global solar manufacturing capacity, and the numbers become staggering. In 2025, solar panel production consumed approximately 130 million ounces of silver worldwide. Industry projections for 2026 show consumption reaching 155 million ounces. This represents a 19% year-over-year increase. Now consider what happened in December 2025. China controls approximately 70% of global silver refining capacity. Chinese refineries process ore from domestic mines, imported concentrates, and recycled materials into the pure silver that industries require. On December 12th, China's Ministry of Commerce announced new export licensing requirements for refined silver. The announcement used careful diplomatic language about ensuring domestic supply security and supporting strategic industries. But the practical effect was immediate. Chinese silver exports to international markets dropped 42% within 3 weeks. This was not a complete export ban, but it functioned similarly. Licensing created bureaucratic delays, quotas limited volumes, and strategic allocation prioritized domestic manufacturers. The message to global markets was unmistakable. China intends to secure sufficient silver for its own industrial expansion, regardless of international demand or pricing. China is currently building solar manufacturing capacity at unprecedented scale. Government targets call for doubling domestic solar installation by 2027. This requires securing silver supply before international competitors. The export restrictions accomplish this objective efficiently. They keep refined silver within Chinese borders while allowing Chinese manufacturers to maintain production schedules. International manufacturers suddenly face a supply crisis. Their previous procurement models assumed open access to Chinese refined silver. That assumption no longer holds. Now examine the supply side constraints. Unlike gold, which is mined primarily for its monetary value, 70% of silver comes as a byproduct of copper, lead, and zinc mining. This creates a fundamental problem. Silver production responds to base metal economics, not silver prices. When copper prices decline, copper mines reduce production or close entirely. Silver output from those operations falls proportionally. The mine operator cannot increase silver production by running the copper mine harder. The silver exists in fixed ratios within the ore body. This means higher silver prices do not automatically generate more supply. Primary silver mines face their own constraints. Developing a new silver mine from discovery to production requires 8 to 12 years. Permitting alone can consume 3 to 5 years in developed nations. Environmental assessments, community consultations, infrastructure development, and financing arrangements create sequential delays. Even if silver prices doubled tomorrow, no significant new mine production would reach markets before 2033. Existing mines face declining ore grades. As mines age, they extract progressively lower quality ore. This requires processing more material to yield the same amount of refined silver. Energy costs increase. Equipment wear accelerates. Operational complexity grows. Some established silver districts show ore grades that have declined 40% over the past 2 decades. Mines respond by closing marginal operations or shifting focus to higher grade sections. Total production volume declines even while prices remain elevated. Recycling cannot fill this gap. Approximately 20% of annual silver supply comes from recycled sources. This includes old jewelry, industrial scrap, and photographic materials. But most industrial silver consumption is effectively permanent. Silver used in solar panels gets sealed into modules installed on rooftops for 25 years. Recovery is technically possible, but economically impractical. Silver in electronics gets distributed across millions of individual circuit boards. Collection and processing costs exceed the metal's value. Silver in medical applications often gets incinerated as medical waste. Unlike monetary gold, which circulates indefinitely, industrial silver largely disappears from available supply. This creates a structural deficit. Annual mine production plus recycling totals approximately 1 billion ounces. Annual industrial consumption exceeds 950 million ounces and is rising. The mathematics only work because existing inventories bridge the gap, but those inventories are depleting. Above-ground stockpiles that accumulated over decades are being drawn down to satisfy current consumption. Eventually, the stockpiles run out. Then industrial demand must be satisfied entirely by current production, and current production cannot meet projected demand. Consider the specific industrial applications. Electronics manufacturing uses silver in virtually every circuit board, switch, and connector produced globally. Silver's superior conductivity minimizes energy loss and heat generation. Alternative materials exist, but they compromise performance. Copper offers lower conductivity. Gold costs significantly more. Aluminum creates corrosion issues. Consumer electronics companies operate on razor-thin margins. They cannot absorb performance degradation or higher material costs without losing market share. They need silver at quantities that continue expanding with global electronics production. Electric vehicles present another demand vector. A typical internal combustion vehicle contains 15 to 28 grams of silver in various electrical components. A battery electric vehicle contains 25 to 50 grams. The automotive industry is transitioning toward electric platforms at government-mandated rates. This transition is not optional. It is regulatory requirement across major markets. European Union regulations require 45% of new vehicle sales to be electric by 2027. Similar mandates exist in California, China, and other jurisdictions. Automakers cannot delay this transition without facing substantial fines and market access restrictions. They must secure silver supply to build electric vehicles, regardless of price. Medical applications create additional inelastic demand. Silver's antimicrobial properties make it essential in wound dressings, medical device coatings, and water purification systems. Hospitals cannot substitute away from silver-based medical products without compromising patient safety and infection control. Regulatory approvals for medical devices require extensive testing and documentation. Switching to alternative materials would require re-engineering products and obtaining new regulatory clearances, a process consuming years and hundreds of millions in development costs. Medical manufacturers will pay premium prices to maintain existing supply chains rather than undertaking that disruption. Defense and aerospace applications add another layer. Military electronics, missile guidance systems, and satellite components use silver extensively for reliability in extreme conditions. These applications are not price sensitive. Defense contractors operate under cost-plus contracts where material costs pass through to government buyers. National security requirements override economic considerations. Military procurement continues regardless of silver prices. When all these demand vectors are summed, the conclusion becomes inescapable. Industrial silver demand is largely non-discretionary, growing rapidly, and cannot be satisfied by current production levels. The supply deficit must be filled by drawing down existing inventories. March 2026 represents the point where inventory levels reach critical thresholds. When industries discover they cannot source the silver their production schedules require, the market faces a choice between halting production or paying whatever price secures available supply. On March 17, 2026, a specific event will occur on the COMEX exchange. Approximately 42 million ounces of silver futures contracts reach their delivery deadline. Contract holders must either roll their positions forward to a later month, settle in cash, or demand physical delivery. Under normal market conditions, this process happens routinely. Most traders close positions financially. A small percentage takes delivery. The exchange facilitates the transfers. The market continues functioning. But March 2026 does not represent normal conditions. COMEX registered inventory currently stands at 28 million ounces. Delivery obligations total 42 million ounces. The arithmetic reveals the problem immediately. Even if every single ounce of registered inventory were allocated to deliveries, a 14 million ounce shortfall remains. This is not a liquidity problem that resolves with time. This is a structural impossibility. The exchange cannot deliver metal that does not exist in its vaults. Now consider what happens when contract holders recognize this reality. Professional traders monitor registered inventory levels continuously. They understand the delivery mathematics. They can calculate the exact point where obligations exceed available metal. These traders face a strategic decision. If they wait for the official delivery period, they risk being among the contract holders who cannot receive metal. Their positions would be settled in cash at prevailing prices, denying them the physical allocation they require. Alternatively, they can demand early delivery or shift to physical purchases outside the exchange system. Both actions accelerate the inventory depletion. This creates a self-reinforcing dynamic. As inventory levels fall, more traders rush to secure physical delivery before the metal runs out. This further depletes inventory, which triggers additional delivery demands. The pattern resembles a classic bank run. When depositors believe a bank cannot meet withdrawal requests, they rush to withdraw before others. Each withdrawal reduces the bank's ability to satisfy remaining depositors. The panic becomes self-fulfilling. COMEX faces an analogous situation with physical silver. The exchange has three potential responses to a delivery crisis. First, they could declare force majeure and settle contracts in cash rather than physical delivery. This has historical precedent. In 1980, during the Hunt Brothers silver crisis, exchanges modified contract terms to preserve market functioning, but force majeure declarations carry severe consequences. They destroy confidence in the exchange's ability to guarantee physical settlement. Futures markets exist specifically to provide price discovery and delivery certainty. If COMEX cannot deliver metal, the entire purpose of trading silver futures becomes questionable. Industrial hedgers and physical buyers would abandon the exchange entirely, moving to over-the-counter markets and direct producer relationships. COMEX would lose its position as the global price-setting mechanism for silver. Second, they could implement emergency margin increases that force position liquidation. By raising margin requirements to prohibitively expensive levels, the exchange could compel traders to close positions rather than demand delivery. This approach preserves the exchange's solvency, but at the cost of market credibility. Traders who planned their hedging strategies around specific delivery dates would face unexpected losses. International participants would view the margin changes as market manipulation. Future participation in COMEX silver contracts would decline as hedgers seek more reliable venues. Third, they could halt trading entirely until additional inventory can be secured. Trading halts prevent the immediate crisis, but create massive uncertainty about reopening terms. During the halt, over-the-counter physical markets would establish prices divorced from exchange levels. When trading resumes, the gap between official exchange prices and physical market realities could be enormous. Each of these responses damages the exchange's long-term viability. But the alternative, attempting to fulfill delivery obligations with insufficient inventory, is impossible. The exchange must choose between various forms of market disruption. Now consider the second-order effects across industries. Solar manufacturers who depend on steady silver supply suddenly face allocation uncertainty. They cannot simply pause production for months while waiting for metal availability. Solar projects operate under fixed-price contracts with specific completion deadlines. Delays trigger penalty clauses, projects become uneconomical, developers cancel orders, manufacturing facilities idle, workers face layoffs. The disruption cascades through the entire renewable energy supply chain. Electronics manufacturers encounter similar constraints. Modern supply chains operate on just-in-time inventory principles. Component suppliers maintain minimal buffer stock to reduce carrying costs. When silver supplies become uncertain, manufacturers must choose between halting production or accepting massive cost increases to secure metal through emergency procurement. Consumer electronics prices rise sharply, product launches delay, market share shifts toward companies that secured supply contracts earlier. Automotive manufacturers face strategic dilemmas. Electric vehicle production schedules are mandated by government regulations. Missing those targets creates financial penalties and regulatory complications. But producing vehicles requires silver in specific quantities at specific times. Automakers with inadequate supply contracts must either pay premium prices that destroy their margin structure or reduce production volumes and accept market share losses. Either outcome damages shareholder value significantly. Medical device companies confront patient safety considerations. They cannot simply switch to alternative materials without comprehensive testing and regulatory approval. The approval process requires years. In the interim, they must secure silver supply regardless of cost. Hospitals and healthcare systems absorb these cost increases through higher device prices, which ultimately flow to insurance companies and patients. Military and defense contractors operate under different constraints. National security requirements override cost considerations. Defense departments direct contractors to secure necessary materials at any price. This creates government-sponsored demand that competes with commercial buyers. Governments can outbid private companies indefinitely using taxpayer resources. Commercial industrial users find themselves priced out of available supply. The pricing mechanism breaks down when one category of buyers has unlimited purchasing power. Strategic stockpiling accelerates the crisis. Once industries recognize the supply constraint, they attempt to build inventory buffers. Companies that previously ordered silver quarterly shift to securing annual supply. This demand surge hits markets already struggling with insufficient production. Supplier relationships become more valuable than price optimization. Companies prioritize supply security over cost efficiency, fundamentally changing procurement strategies. Government policy responses introduce additional complexity. Nations may implement export controls on silver, similar to China's restrictions. Domestic supply gets prioritized over international sales. This fragments global markets into regional silos. International trade in silver becomes subject to political relationships rather than pure economics. Supply chains that depend on cross-border metal flows face persistent uncertainty. Historical precedents offer limited guidance. The 1979-1980 silver crisis involved price manipulation and speculative excess. Markets resolved through regulatory intervention and position limits, but that crisis involved abundant physical supply and excessive speculation. The 2026 situation involves insufficient physical supply and growing industrial demand. The resolution mechanisms are fundamentally different. Price increases alone cannot solve a structural supply deficit in the timeframe industries require. The March 2026 threshold represents more than a single delivery crisis. It marks the point where decades of underinvestment in silver production capacity collide with exponential growth in industrial applications. The paper market that provided price discovery and hedging tools for generations proves unable to guarantee physical delivery. And industries that built their operations around reliable silver availability must restructure their entire supply chain strategies. For business decision makers, the implications are immediate. Companies with silver-intensive operations should be evaluating supply contracts, exploring alternative procurement channels, and assessing exposure to delivery failures. This is not a trading opportunity to exploit. This is a structural market transition that will reshape commodity trading, industrial supply chains, and the relationship between paper markets and physical reality. The countdown to March 17th is not measuring time until a price move. It is measuring time until the market system itself faces a credibility test it may not pass. What happens when the promise of delivery meets the reality of empty vaults? The answer will define commodity markets for the next decade.